We're in the midst of one of our stock specials. Koshi wants to know what you would buy if there was a more significant pullback. So if we saw, let's call it a crash, more than a 5, 6, 7% pullback, what would be top of your shopping list? Andrew, let's start with you.
Now, Nadine, you're going to think I'm going to say ETF, aren't you?
Well, wouldn't surprise me.
Bong bong, wrong. No, today I'm going to mix it up a little bit. Macquarie would be my choice.
Yeah.
And full disclosure, I used to work for them. That's not the reason I'm suggesting it, but just getting that out there early. So using sort of the Koshi parameters of a bit of bother about, if we take our minds, as painful as it is, back to 23 March 2020, Macquarie bottomed out at $76. Having previously back in February been trading at $156. So I think we could call that a crash. That's a pretty decent pullback. But subsequently, as we can see, Macquarie's been on a bit of a tear, $182, $183. Why do I like the holy donut? Look, there's a few reasons. They've got a very strong annuity style business, about $790 billion now of FUM, having recently made some acquisitions, and from that comes some pretty significant recurring revenue as well. The other thing I like, Nadine, is that its return on equity is around 13%. So as you know, I'm a bit of an ROE fan, and a 13% ROE. And if we compare and contrast that to other investment banks, that's pretty strong. And in fact, out of the retail banks, only Commonwealth Bank has got an ROE which is similar. CBA's is about 12%. So strong return on equity, good recurring income streams, lots of funds under management. And if things do continue to go along as they are at the moment, then from an opportunity or deals point of view, there's lots of deals that Macquarie got their fingers in, lots of pies. So MQG is the go-to here, Nadine.
Now, I have to just push the point a little bit. Obviously, a crash is not a technical definition, but if we say that Macquarie is trading at $183 right now, which it is, I mean, hindsight's 2020. I wish I'd loaded up at $76 on the 23rd of March, 2020. We don't want such a black swan event to happen again. So what would be a reasonable price to you to buy Macquarie if we saw some sort of a pullback? I mean, would it be 10%? What would be a price you'd be willing to pay?
I want to see what the markets come back first. So let's say it's a standard correction. So standard correction, as Michael would, I'm sure, agree with me without trying to burgle him. Once every year you probably see a standard 10, maybe sometimes up to 20% correction. So using those parameters around, I'm just looking at the chart as well, I would think around that 150, 155. If it was around those levels, I'd be loading my boots up.
Great. Our viewers will be happy. How about you, Michael? What would you buy if there was a crash, say a 10% correction?
Well, I interpreted this as a full-blown crash, not a little piddly correction. So I've gone for Commonwealth Bank. Looking back at the GFC in 2008, we saw that the share price pulled back from about 60 down to about $30 a share. And even last year or 18 months ago when COVID first came onto the scene, we saw Commonwealth Bank pull back from around sort of $90 down to 70 or even 60. I think it might have even been mid 60s. So the idea is that when a crash is upon us, uncertainty is at its highest. And along the same lines as Andrew, I think in those situations, you want to go for very high quality businesses. And CBA, I think, ticks the box. In those scenarios, you often think, or people often think, that everyone's going to lose their job. No one's going to be able to pay back their mortgages. The assets that these mortgages are backed by, being property, they're going to fall through the floor. So often everyone's pricing in a doom and gloom scenario. And as it often turns out, the worst case scenario doesn't transpire. So for something in a very, very turbulent market, I think you can't really go past something like a Macquarie or something like a CBA, because although I don't necessarily think the long-term growth profile for CBA is terrific, at times of a crash, I do think you do get the opportunity to pick up a very good quality business at a very big discount. So that's why I'm leaning to that. You can probably throw in Westpac and ANZ as well, along similar lines of thinking.
Got it. Thanks, guys. Now just keep it quick, but to just clarify, Michael, you're not expecting any sort of a crash to come through. We are in a period of heightened volatility. We are in a period of rising bond yields. but has that changed sort of your view on the overall trajectory of the market going forward?
No, I'm pretty optimistic on the outlook. Obviously, there's a few issues to take into consideration at the moment, but I think if you look through history, it's very rare for large-scale crashes to occur when economic growth is still growing quite quickly, and we're coming out of a period of recession. I think we're probably somewhere in between the recovery phase and the next downturn. Yes, economic growth numbers might be slowing a little bit, but they're certainly still growing at a decent clip. So you have to always be careful. But like Andrew touched upon, a 10% correction is common at least once or twice a year looking back through history. So the September, October, weaker months of the year, a little 10, 15% correction probably isn't the worst thing in the world. It does at least bring back valuations a little bit.
Now, just a quick one from you, Andrew. Is there a crash? Or is there likely a correction, a further correction between now and say the end of the year? I had my first email from a viewer saying, Nadine, you've got to start asking about a Santa Claus rally and the chance of that.
Rightio. No, look, and perversely, I want another 5% down. So we're down about 5. I want another 5% down. We've had 11 months where up until September, we didn't draw breath. First time since 1942. Sure, Michael would agree, not healthy. You need it to pull back. So another 5%. We set ourselves up quite nicely for November and into that Christmas Santa Claus rally. Agree with everything that Michael said. Probably the only sort of other thing to think about short term around the noise, US debt ceiling and third quarter earnings coming into the US next week. But generally speaking, another 5%. Andrew's very happy.